For as long as most of us can remember, the US dollar has been the bedrock of the global economy. It's the currency everyone turns to. But what happens when that foundation starts to show some cracks? Today, we're going to dive deep into this really intense debate about the dollar's future. And believe it or not, it all kicks off with one very mysterious phone call. So, can a single phone call really shake the entire world's financial system? I mean, it sounds like something out of a movie, right? But this isn't fiction. This actually happened. One call had traders totally glued to their screens, wondering if the financial world they knew was about to get turned upside down. So, what was this call all about? Let's get right into it and break down exactly what went down and why it sent such massive shockwaves through the market. All right, picture this. It's Friday, January 23rd, 2026. The Federal Reserve Bank of New York, we're talking one of the most powerful institutions in finance, starts making calls. They're ringing up currency traders with a question that sounds deceptively simple. Hey, what's the yen-dollar exchange rate looking like right now? Now, let me be clear. This was not just a friendly check-in. In the world of finance, this is called a rate check, and it is a massive red flag. It's the kind of thing that makes everyone, and I mean everyone, stop what they're doing and pay very close attention. The whole market was on edge, instantly. So the Fed asks this question, and the market's response? Well, it was fast, it was dramatic, and it showed exactly what traders were worried about. The second that news got out, the Japanese yen just shot up, and the US dollar took a serious nosedive. Why? Because traders are experts at reading between the lines. They knew this wasn't just a question. No, this was a warning shot. It signaled that the US was getting really concerned about how weak the yen was. So you might be thinking, okay, but what's the big deal? It's just a phone call, right? Well, here's why it caused such a panic. Investors knew this could be the opening act for a much, much bigger and more aggressive move from the US. And that bigger move is called currency intervention. This is basically when a central bank decides to throw its immense weight around. It starts buying or selling huge amounts of currency to literally force the price where it wants it to go. And that rate check, it's the classic first step. It's like the canary in the coal mine for the financial world. And look, when the US decides it's going to intervene, it completely changes the game. As one strategist, Gareth Barry, put it so well, Japan has lots of dollars to sell, but the NY Fed has an infinite amount. Just think about that for a second. The US can literally print dollars to win this fight. That is a level of power that absolutely terrifies markets. So, who's actually calling the shots here? Well, the US Treasury is the one that sets the policy. They decide if and when to act. But it's the Federal Reserve that's on the front lines, the ones who actually execute the trades and make it all happen. But this whole phone call thing, it didn't happen in a vacuum. It basically poured gasoline on a fire that had been smoldering for a while. This big debate over the dollar's long-term value, something people call debasement. To really get why everyone was so anxious, you have to zoom out and look at the bigger picture. The dollar was already hurting. I mean, it had already dropped more than 9% against other major currencies in just over a year. It was at a 3-year low. So this wasn't a new problem. It was a problem that was getting worse. And this steady decline is really the heart of that whole debasement debate. Is the US government actively trying to weaken its own currency? And if they are, what does that mean for the dollar's special status as the world's go-to reserve currency? And it's not like there's just one thing to point to. It's more like a perfect storm of pressures. You've got a potential new Fed chair who might lean towards policies that weaken the currency. You've got ongoing trade wars. You have serious worries about massive government debt. And on top of all that, you have this intense political division. All of these things are making holding on to dollars feel a whole lot less safe. So you have to wonder, is this kind of thing, this dramatic government move, totally unprecedented? Not at all. And to really understand the stakes, we got to take a quick look back at some really important moments in financial history. Now, let's be clear. These kinds of coordinated moves are basically the nuclear option in finance. They do not happen often. Think of it like a global summit, but just for currencies. And it's only called when things are really, really critical. We've actually seen this playbook run before. You can go all the way back to 1985 with something called the Plaza Accord, which was a big coordinated push to weaken the dollar. Then again in 1998, the US and Japan teamed up to rescue the yen. So that rate check in 2026, it suddenly made these old history lessons feel very, very relevant again. Okay, I know that's a lot of high finance talk. Central banks, rate checks, historical accords. So let's just cut to the chase. What does any of this actually mean for you, for your wallet, for the economy? Let's get to the bottom line. A weaker dollar is a classic double-edged sword. On one hand, it can be great news for American companies that sell stuff overseas. All of a sudden, their products get cheaper for other countries to buy, making them more competitive. But, and this is a big but, the flip side is it can spark inflation right here at home. The cost of everything we import, from cars to clothes to coffee, starts to go up. And that hits you directly. So when you put it all together, that one phone call was so much more than just a call, wasn't it? It was a symptom of a much deeper problem, a much deeper anxiety in the markets. With all these pressures mounting from every direction, from our own politics to huge shifts in the global economy, we're left with this one massive lingering question. After decades of just total dominance, is the US dollar facing its biggest test yet? Only time will tell.